2 investing rules that could protect your money. Welcome back to our channel, where smart money meets timeless strategy. If you're serious about protecting your wealth, today's video is essential viewing. We're breaking down 2 powerful investing rules that every successful investor lives by. Rules that could shield your money from the next big crash. Whether you're new to investing or managing a growing portfolio, this is your roadmap to safety and long-term success. Let's dive in. In a world where financial headlines swing from optimism to crisis within a day, protecting your hard-earned money becomes more than a goal, it becomes a necessity. Whether you're a seasoned investor or just starting your journey, one truth remains constant: the market is unpredictable. But that doesn't mean you have to be unprepared. There are 2 fundamental investing rules that have stood the test of time, rules that don't just help grow your wealth, but protect it. While countless strategies come and go, these 2 principles serve as the financial equivalent of seatbelts in a speeding car: simple, reliable, and potentially life-saving. Let's dive into them. Rule number 1. Never lose money, the rule of capital preservation. This rule might sound obvious, even overly simplistic, but it's rooted in a powerful idea, one popularized by Warren Buffett himself. In his famously dry wit, he once said, "Rule number 1, never lose money." Rule number 2. Never forget rule number 1. At first glance, this might seem unrealistic. After all, every investment involves risk, right? So how do you reconcile the idea of never losing money with the reality of market volatility? The answer lies in capital preservation, the principle of prioritizing the safety of your principal over risky returns. Magnifying glass: why it matters when you lose money, the road to recovery is steeper than it looks. If your portfolio drops by 50%, it doesn't take 50% to recover, it takes 100%. A loss of $50,000 on a $100,000 investment means you need to double your remaining money just to break even. Losses don't just slow you down, they reverse your progress. This is especially critical for people nearing retirement or relying on their investments for income. For them, a single bad year can alter decades of planning. How to apply this rule: know your risk tolerance. Everyone says they're okay with risk, until the market crashes. Understand your emotional threshold for losses and invest accordingly. Diversify wisely. Don't put all your eggs in one basket. Spread your investments across asset classes: stocks, bonds, real estate, commodities. Diversification cushions losses when one sector underperforms. Keep a margin of safety. When buying stocks or properties, aim for undervalued assets. A good deal gives you breathing room if prices drop. Avoid trends and hype. Chasing hot stocks or crypto coins based on internet buzz is the opposite of capital preservation. If it feels like gambling, it probably is. Use stop-loss orders. In trading, a stop-loss order automatically sells a position if it drops below a certain point. It can prevent catastrophic losses. Preserving capital doesn't mean avoiding risk altogether, it means managing it intelligently. Think defense, not just offense. Rule number 2. Only invest in what you understand. Another often overlooked but crucial rule is this: if you don't understand it, don't invest in it. This may sound overly cautious, but history is filled with cautionary tales of people who poured money into investments they couldn't explain, and lost everything. Whether it's a complicated derivative, a shiny new crypto token, or a can't-miss startup, investing in something you don't fully grasp is like driving with your eyes closed. Why understanding matters: understanding creates clarity, and clarity creates confidence. When you know why you're investing in something, you're far less likely to panic during a downturn or sell out of fear. You can analyze, adjust, and stay rational when everyone else is reacting emotionally. Lack of understanding is one of the biggest reasons people buy high and sell low, because they're acting on emotion, not knowledge. How to apply this rule: stick to your circle of competence. If you understand real estate, invest in it. If you understand tech companies, research them. The key is staying in your zone, not chasing what you don't know. Ask these questions before investing. What does this company or asset actually do? What drives its value? What are the risks involved? How does it make money? What could cause this investment to fail? Don't rely on experts alone. Financial advisors, influencers, and even analysts can be wrong. Use their insights as input, but not as a substitute for your own due diligence. Avoid FOMO, fear of missing out. Just because everyone is piling into something doesn't mean you should. If you don't understand it, sit it out. Educate yourself. The best investors are lifelong learners. Read books, take courses, follow trusted financial sources, and keep sharpening your knowledge. The more you know, the safer your decisions become. Remember, understanding breeds control. And control is the opposite of chaos in investing. Why these two rules work together when combined? These two rules create a powerful investing framework. Never lose money, keeps your downside in check. Only invest in what you understand, helps you avoid emotional mistakes. Together, they protect your capital from destruction and your mind from confusion. They force you to be thoughtful, patient, and deliberate, a mindset that's rare in today's fast-moving financial world. In a time where anyone with a smartphone can trade in seconds, these rules slow you down just enough to think. And in investing, thinking, not reacting, is where the real advantage lies. There's no magic formula to guarantee profits in the market. But there are timeless principles that shield you from unnecessary loss and impulsive decisions. If you're serious about building wealth over time, remember, protect your principal. The first loss is often the hardest to recover. Don't invest in what you don't understand. Confusion is costly. These two rules are more than advice, they're a mindset. A commitment to protecting your money, your peace of mind, and your long-term goals. Because investing isn't about being the fastest or flashiest, it's about staying in the game long enough to win. Remember, wealth isn't just about what you earn, it's about what you protect. These two rules may be simple, but they're the foundation of lasting financial power. If you found this video helpful, be sure to give it a like, subscribe for more timeless financial strategies, and turn on notifications so you never miss an episode. This is Dynasty Fortune, where your legacy begins with smart decisions. See you in the next one.